Today I have the pleasure of speaking with somebody with over 30 years of experience in capital markets across various Indian reputed financial firms. He's senior partner and CEO at Rare Enterprises. He's also a friend mentor at Trust Group. He's director of Trust AMC as well. Hello, Utpal ji.
Hi, how are you?
Very well, sir. How are you doing?
Good.
Great. Good to have you here.
Thank you. It's a pleasure being with you. Yes.
So, sir, to start off with, how has your journey been in the financial industry?
It's been a long journey. I started my career right after my 12th grade exams. I have been very, very fortunate to work with some of the finest minds in the Indian financial markets across multiple functions and multiple verticals within the financial sector. I've been very fortunate to have exposure across multiple asset classes, multiple types of buy-side and sell-side functions. So I consider myself very fortunate. I started my career with ASK Financial and learned a lot from Mr. Asit Kutecha. And then I worked with my father, who passed away in 2022, in his firm. My father used to be the head of research and portfolio management at JM Financial before he started his own business. And after that, I joined Inam Financial. Again, was fortunate to work with likes of Vallabhbhai and Nimishbhai and Akash. And thereafter was privileged work with Rakeshji at Rare. I was the first front office team member of Rare Enterprises, which was Mr. Jinjanwala's proprietary firm, or Bhaiya as we used to call him. And all of them have been fabulous teachers and mentors for me. I've learned so much from them, not just about financial markets, not just about investing, but also about people, also about life, also about having the right attitude to things, about being practical, about being decisive, and so on. I've been active in equity research, institutional sales, portfolio management, financial product distribution, and investment banking and investing through the span of my career of 30 odd years. Finally, I've been exposed to both equities and within equities, public equities as well as private equities. I've been involved in different kinds of transactions and functions. So both in public markets and in private equities, in mergers and acquisitions, LBOs, MBOs, various capital market transactions, and advisory services like shareholder value creation, and of course, writing research reports and so on. So a whole gamut is what I've covered. I've been, and through Trust Group, apart from equities, I have also gotten exposed to fixed income securities as an asset class, to real estate capital markets as an asset class. So it's a very privileged vantage point of view that I've been fortunate in having. And above all of this, I would say, is the fact that I've been able to work with so many different companies over the years, being engaged with them over such a long period of time, seeing how the decision-making frameworks of the promoters evolve over a period of time, what their priorities are, what are the factors which create value, what are the factors which destroy value. Hence, I feel I've been blessed to have this journey so far.
Great, sir. So, sir, what has been your personal experience with terminal value investing? Could you shed some light on it?
My journey with terminal value investing has evolved over the years. And when I first started doing equity research way back in 1988, I did not think about terminal investing at all. I have made the transition and evolution from the traditional approaches to investing, which include maybe value investing, growth investing, momentum investing, and a whole host of other investment style. I've come to the conclusion that, at least for me, it is terminal value investing that works. However, terminal value investing is not easy to define, and it makes having a very long-term time horizon a condition precedent to terminal value invest. While we talk of this long-term time horizon, right? The long term is made of many short terms, right? One has to have the ability to pass through those many short terms with equanimity, with a state of mind which does not get adversely impacted by volatility or news headlines, etc. There are times when you need resilience in the face of negative returns, but I have learned that it all pays off in the long term, so long as one is clear about the terminal value that one is pursuing.
So this reminds me of a famous two-wheeler ad: fill it, shut it, forget it, and just avoid the noise and keep moving on.
I know the famous two-wheeler ad that you're talking about, and I remember that ad. Investing is different from that. Fill it at the time of buying is a function of your conviction.
Right.
And even after you have conviction, it's not enough. Apart from conviction, you also need to have the courage to buy at that time, right?
Correct.
So you need both conviction and courage to buy, which is what you can equate to fill it. Shut it is, investing is a very dynamic space, and terminal value is not a static variable. It itself is a dynamic variable. Therefore, terminal value investing requires that while you are patient and you look at things with equanimity, it does not mean that you are complacent. It does not mean that you are not actively tracking the short-term and long-term factors which influence the fortunes and the terminal value of the company that you have invested in.
Right.
And lastly, forget it is not a luxury that investors have. Even if an investor is holding a stock for 5 years, 10 years, 15 years, 20 years, you cannot forget it. Because one reality of life is that while value creation happens, value migration also happens. Okay, so value can migrate towards the company that you have invested in, and value can migrate away from the company that you have invested in. So one has to be conscious of that. Those are not short-term factors. They happen once in many, many years. But you don't know when that factor is going to happen.
Right.
So you need to be watchful. You need to be alert. And while everybody thinks of investing as a buy, hold, or sell decision only, I think what most people miss out is the fact that it's a probabilistic portfolio management decision on a continuous basis. If you invest in the best stock in the country, but that stock is only 0.1% of your portfolio, it's not going to have a huge impact on your portfolio.
Right.
So you have to ensure that your conviction is adequately reflected in the weights that you assign to each stock in your portfolio. Same way, risk comes in very many different ways. You have to have a portfolio which is not just diversified, but which is also reflects the uncorrelated aspects of the portfolio. If all of them are correlated, then you're betting on the same horse, no matter that they are different companies.
Certainly.
So I would say that fill it, shut it, forget it is not strictly applicable to investing, and active portfolio management and risk management is something that every investor should be focused on and conscious of.
How do megatrends, intangibles, leadership contribute to investment success in your opinion?
So in the terminal value investing All of these are very crucial components. If you are not participating in a mega trend, which means you have a very long runway of growth in a large, what we call as TAM, total addressable market, then the size of the opportunity is not favorable for you. You must ensure that you invest in companies which are operating with large addressable markets and with a long runway for growth. However, just that is not good enough. You need to have the right leadership capabilities as part of that company that you invest in, the right business model which gives you some competitive advantage in that chosen space, such that you can make the most of that large addressable TAM and runway for growth over a very long period of time. So we look for that competitive edge as well. Both these factors, mega trends and leadership, would not be worth a lot. They are not sustainable. And what makes those sustainable, especially the internal factors, what makes it sustainable, are what we call as intangibles. Intangibles are a myriad of assets of the company, which are not factories, which are not buildings, etc., but assets in terms of maybe the culture that they have, the quality of people that they have, the practices that they follow, the processes that they follow, the prudence that they have inculcated, risk management that they have inculcated. It could be the brands that they have built over the years. It could be the distribution networks that they have built over the years, and many more. So there are a whole host of these intangible assets which create value. So we feel that leadership, intangibles, and megatrends, all these three factors contribute the most to the terminal value of a company. As a terminal value investor, since I'm pursuing that terminal value of the company, it is better that I go to the root cause of that terminal value, which is leadership, intangibles, and megatrends. Sometimes you get 2 out of the 3. Sometimes you get 1 out of the 3. Very rarely do you get all 3. Which is why when you get all the 3, you should ensure that you have your conviction in place, and that conviction and courage helps you to make it the right weight in your portfolio, such that it makes a material difference over the long run to your portfolio. Many times we've seen that even if you get one of these 3 factors right, it works out. But it runs out of steam in a few years. So when you start investing and building a portfolio, maybe all the companies are not gorilla stocks. Gorilla stocks are stocks which satisfy all of these 3 factors and which are embedded in the terminal value of that company, which is what you are pursuing. So sometimes you realize that what I thought was a gorilla stock was not a gorilla stock. It's okay. We are all humans and we will make mistakes. But as time evolves and your portfolio decisions are mature, you realize that a larger and larger portion of your portfolio is made up of gorilla stocks, which have large terminal values, and which is your holy grail in terminal value investing. Like gorillas are different from monkeys in the jungle, right? They probably...
Gorillas are what? Kings of the jungle. Kings of monkeys, I would say.
Thinking of kings, let me explain that differentiation a little more. Gorillas are rare. In any jungle, you will have very few gorillas and many monkeys.
Many months, right?
Gorillas are also dominant. They are much bigger, right? And while you will find a lot of monkeys being together, those monkeys will stay away from the gorillas, right? So the gorillas make their moats in such a way that the monkeys stay away, right? Also, biologically, the lifespan of a gorilla is far greater than the lifespan of a monkey. And that demonstrates longevity. Gorillas, when they walk, everybody makes way for them. That demonstrates leadership. So in many ways, gorillas represent those attributes that we are looking for in companies that we invest in. Over the years, these gorillas grow to such a size and scale. So sometimes a stock that you have invested in which had and made it 5% of your portfolio ends up becoming 10 and then 15% of your portfolio. I know that in a mutual fund format, there are restrictions on the concentration levels of one stock. In general, the properties of gorilla stocks is that they keep compounding at a faster pace, and that is what we are all going after.
So for a layman who's not into active trading, day trading, if a layman wants to invest in a mutual fund or direct equity, how does one identify a gorilla stock without getting too much into details and nuances of it?
See, every person has his or her circle of competence. Okay. And within that circle of competence, that investor is able to intuitively identify the most valuable player. Okay. He or she may not understand financial ratios, they may not understand valuation multiples, etc., but they can identify that this company is different. So over the years, the loyalty of individuals to different brands is a reflection of their identification that there is something different about this company. If one goes in that direction, as a layman also, one will realize that. For example, if you take the case of a bank, every investor is putting his or her hard-earned money into a bank. He will want to ensure that he's putting his money into a bank which is safe, right? And he may not understand what value which bank creates, but he understands which bank is safe and which bank is not safe.
Right.
So I think most people intuitively have an appreciation for what works and what does not work.
Just by observing day-to-day affairs of the bank or any company, they can at least figure out that, you know what, this is safe to me.
Safety is one aspect, but also convenience is another aspect.
Convenience.
Right? Quality and consistency is a third aspect. So all of those things come together in the minds of even the lay investor, and I'm sure they can appreciate and participate in such companies. Having said that, I do believe that most lay investors are not able to translate all of those into long-term investment decisions, and therefore maybe a mutual fund route makes more sense for them, in so long as they have they believe in the investment philosophy and the investing framework of the mutual fund that they invest in.
Because mutual fund will wipe out the emotional bias out of an individual, and obviously there is a professional who's managing the portfolio with the team as well.
See, I don't know about wiping out the emotional bias. Yes, there are professionals investing in a mutual fund, and therefore they will hopefully not have all the same biases, but each one in the mutual fund space, or even as an investor, Um, each one has his or her own shortcomings, and we are all humans. We will all make mistakes. What is important is whether we learn from our mistakes and whether we have the discipline to ensure that we don't repeat the same mistakes.
Right.
In trying to avoid mistakes, I've realized that one also avoids a lot of opportunities. Right? So there is a trade-off between mistake aversion and opportunity cost. I would say that you have to make mistakes that you can afford, learn from those, and keep evolving to be a better investor tomorrow than you are today.
Right.
And I think it's a journey that's a beautiful journey that every investor must pass through.
So when we talk about investment, from your perspective, how crucial is value migration?
That's an interesting question. See, value creation is what the promoters and managements of companies do. As investors, we participate in the value that they create. I always say that wealth creation is a function of value creation. We as investors have to be conscious that it's the promoters and management teams which are creating value. But while they are creating value, there are certain changes which are happening both inside the company and outside the company, which can impact the path of value creation. So there's this famous book called Value Migration by Adrian Slybotsky. And it says that value migration happens when the customer needs and the business models which are serving those customer needs, they start drifting apart. So then value migration happens for or against you, depend on whether the divergence is in your favor or against you. One has to be conscious of that because it impacts terminal value. As an investor, that terminal value is important to me. So I will always be conscious of value migration. But value migration, when it reaches critical mass, it happens at a very rapid pace. The flywheel starts working for you. So I would say that value migration happens over long periods of time. However, as an investor, those who can identify the value migration make wiser portfolio decisions. Rakeshji has taught me that investing is an act of wisdom, not an act of intellect. Okay, and I believe that if you are smart and intelligent, you can identify companies which are growing fast. But you need wisdom to identify companies which will create that value and companies that benefit from value migration such that terminal value is substantial.
So, sir, would you recommend prioritizing making money or creating wealth in the longer term?
My first boss explained to me when I joined that I can give you fish that you can eat for a day, or I can teach you fishing, which will feed you for a lifetime. And really, I think the difference between making money and wealth creation is like that. Wealth creation is a journey and not a destination. It is a journey in which you compound not just your money, but you compound your learning, you compound your knowledge and wisdom, you compound your relationships. It's a beautiful journey. Making money is very transactional and very short term, very opportunistic. I don't know how sustainable it is. So I would say I would strongly advocate wealth creation in the long run. as compared to looking for transient trading opportunity. But you know what? It is whatever works for each one of us. I'm not here to prescribe anything to anyone. There are some people for whom trading works. Good luck to them. There are some people for whom investing works, and good luck to them too. I think I'm in the believer of investing and wealth creation and compounding camp. So I believe in that.
Talking about asset allocation, just out of curiosity, what would be your portfolio mix in terms of percentage in equity, real estate, and commodities, if I may ask?
So asset allocation is very unique to each individual in the context of their circumstances, I would say, including financial circumstances. So younger people will have a different asset allocation. People with significantly higher income streams and visibility of the longevity of those income streams will have a different asset allocation, and so on. So I don't want to get into the specifics of, there is no one right asset allocation. So I don't want to get into the specifics of that asset allocation. When it comes to my asset allocation, again, as I said, my asset allocation is unique to me and my circumstances. As to what I will advise my daughters in terms of their asset allocation is quite clear. I believe in the power of compounding, and therefore every asset class which can keep compounding is right for them. Different asset classes compound at different pace, but they also have different risk profiles.
Right.
So the balance of that risk and reward profile is where the mix of right asset allocation comes.
So, sir, according to you, how do you think the asset management industry in India look like 10 years from today?
See, Indian asset management industry has come a long way from the Unit 64 days. And I think the AUM of Indian mutual funds, or even, let's say, the portfolio management AUM or AIF, which is alternative funds AUM in the country, have all been growing at a fairly rapid clip. And which is probably going to be the way forward as well, given that our per capita incomes will go up. More importantly, as a country, we are shifting from the unorganized sector to the organized sector. And as a country, we are moving away from conventional physical assets like real estate and gold towards financial assets, a greater proportion of financial assets, which include mutual funds, PMSs, AIFs, and other such opportunities. So we call this mega trend as financial deepening. I believe that financial deepening has been going on for many years now and will continue for many years from now. If India is to be the third largest economy in the world, the kind of wealth creation that will happen over the coming decades will be massive. There is a dire need for that wealth to be managed well. And I think the asset management industry is well poised to do that. Indian regulators have been very proactive and conducive in facilitating the growth and ensuring that there are no mishaps along the way. So such growth potential along with good regulation is a rare combination. That rare combination, I believe, will facilitate the growth of the Indian asset management industry into the future. There will be giants in asset management coming out of India over multiple decades. and we aspire to be a relevant and differentiated player in the space. We are entering at a later point of time than our peers, but hopefully we will demonstrate our differentiated approach to our investors, and our investors will then believe in us over a period of time. The asset management industry growth is a given. What I think will be even more interesting is the breadth of products, choices, and opportunities that this industry can make available to Indian investors. And I think there is space for more players to come up with more offerings, and so on. And most of us are aware of those structural changes that are happening in favor of India. So there will be many investment opportunities. I believe that Trust Mutual Fund Flexi Cap Fund is one of those opportunities where a committed team is providing a differentiated investment philosophy and approach, and which is committed to doing the right things in the right way. I believe that that is what investors will appreciate in the long run, and we are here to present a compelling case for that.
Sir, I would also like to know more about your views on the Trust FlexiCap Fund.
I think India is at a very interesting juncture, and we are on our way to be the third largest economy. We are already the fourth largest market cap in the world. Every year we are growing at amongst the fastest pace within all substantial economies. We are going to be adding more than 20% of the incremental global workforce over the next decade or two, and so on. And most of us are aware of those structural changes that are happening in favor of India. So there will be many investment opportunities. I believe that Trust Mutual Fund Flexi Cap Fund is one of those opportunities where a committed team is providing a differentiated investment philosophy and approach, and which is committed to doing the right things in the right way. I believe that that is what investors will appreciate in the long run, and we are here to present a compelling case for that.
So, sir, Trust Group is one of the leading financial services in the country today and has won multiple awards. Can you tell us more about your journey with the group, and how was it when you started it, and where are you today?
So, I've been a mentor for Trust Group, and as I explained to you, Trust Group has two significant verticals. One is the debt capital markets vertical, and the second is the advisory, wealth and asset management vertical. Over the years, Trust has built a leadership position in the debt capital markets and has won many awards across different components of the debt capital market value chain, whether it is origination, intermediation, or distribution. Within the advisory, wealth and asset management vertical, Trust Group has been working towards building a differentiated approach to those verticals. And this combination of leadership in transactional businesses like debt capital markets, and differentiated approach in annuity businesses like advisory, wealth and asset management business, I feel is a very powerful combination. Trust Group was not always having this combination. It has evolved over a period of time. But Trust Group has a track record in innovation in debt capital markets, which is, I think, very different from almost any other debt capital market investment bank, right from certain securitization transactions to domestic green bonds to the first additional tier 1 capital market, additional tier 1 bank bonds, etc. So that innovation track record includes the first commercial mortgage-backed securities transaction. It includes the first... so these debt capital market innovations, I think, are helping in widening the investment opportunities that Indian investors have access to. It has won awards in... it did the first... Trust is also pretty active in REIT bonds and InvIT bonds. So you will find that this is one of the few houses which has expertise across multiple asset classes. In this journey of evolution, we've been fortunate to have a professional and stable leadership team over the years, with a healthy combination of best-in-class lateral talent, which has joined Trust Group from time to time. And we are presenting our investors with all the set of capabilities that Trust Group has in order to ensure that we put our best foot forward in the mutual fund space.
How many companies do we have under Trust Group, and what all domains are we catering to?
See, there are a number of entities, because you must realize that financial services is a regulated business, and we take those regulations very seriously. So various activities need various licenses, and accordingly entities are set up which are relevant for different businesses. Having said that, at Trust Group, for us, institutionalization is very important. We would like to ensure that this institutionalization and professionalization takes place in the interest of longevity and sustainability of the business and of the company. We are also very keen that not only should we be doing the right things, but also in the right way. To us, both the means and the ends. We have a few key values at Trust Group, which we respect a lot. Those values are our guiding factors.
Thank you for joining us today, sir. It was lovely to interact with you, and wishing you all the best for the NFO launch of Trust Mutual Fund.
Thank you
once again.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.